This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome back, everybody, to Avoiding the Crowd podcast. I'm your producer, Bobby Kraft. You can follow me on Twitter at Bobby K Kraft, BOBBYKKRAFT. But enough about me. This is all about who you see right here. Okay, we got our host, Maj Soueidan. But enough about him. It's about who else we got right here. We got Tobias Carlisle from at Greenback, the Acquirers Multiple, the Acquirers Podcast, friend of the SNN.Network. I think that's the most important title, but I digress. With that, what's up, gents? How we doing today?
I'm great, Bobby. Thanks for forcing Tobias to be here.
I really broke his legs to do it.
Any chance to chat to you, Maj?
Oh man, so yeah, well, this is great because I mean, the last time we spoke was maybe the summer, I guess, when you were gracious enough to have me on your podcast, which was awesome, man. It really helped me get out there a lot, and we helped Geo a lot, and we got a lot of followers from that. So I really appreciate that.
Oh, good, my pleasure. I'm happy it worked.
That was really a fun time.
Well, with that, I'm gonna hide, and you guys chat. You guys have some fun. I'll be over here, and all right, peace.
Hey,
I'll be listening. Cool. Let's hear what goes
Bobby.
On. All right.
So I wanted to talk about a few things. I just wanted to chit chat a little bit today and see where it goes. We really I never had a discussion with you about your Acquirers Multiple website, and I find it really interesting. I read about it and been to the website to look at it, and you have this ETF now. You're changing focus with your ETF, which I think is pretty interesting. I have some questions around that. So I want just talk about some of the things that have been going on in your life, your last 6 months, and the direction you've been going and why you made some of the changes you made.
Yeah, so we've taken over another fund. It used to be the old DVP, and now we've renamed it Deep. So I've partnered with the guys at Roundhill. They have 2 other ETFs, and they were looking for a value tilt because everybody knows that value's been underperforming, and I think that the opportunity through that underperformance has been getting greater and greater. And I think that the place where I think the 2 places where it's most magnified are small and micro cap value. And I also think that the spread between the most overvalued and the most undervalued is as wide as it's ever been. So I have 2 ETFs. I have ZIG, which is a long short value ETF. And I have Deep, which is long only small and micro cap. And together they cover the entire universe of stocks, but ZIG is the largest 25%, and Deep is the smallest 75%, with a cutoff of $75 million, which is the smallest that you can put into an ETF. And so the Deep portfolio is 100 stocks long, all equal weight at inception. They all sort of have the same characteristics in the sense that it's the same philosophy that I have in ZIG, which is looking for, I like really healthy balance sheets. I like free cash flows. And to the extent that I can find it in small and microcap stocks, I prefer them to be buying back stock rather than issuing stock. And it's my favorite part of the market. It's where I kind of got my start. So it's nice to be coming back to small and micro.
Yeah, so for those who don't know you, so your start was in the small cap, micro cap arena, right?
Yeah, I ran a little blog on a website called Greenbacked, which is how my Twitter handle is the same. It's still Greenbacked. It's a funny spelling. It's GREENBACKD. The idea was it was like punked. You remember that Ashton Kutcher show?
Yeah.
Like where you I couldn't get the .com that had the ED at the end, so I just got the D. But the idea is that it was stocks that had like greenbacks were backed by cash. So I wanted net cash, nets, And then on top of that, I wanted some sort of activist in there pushing to resolve the situation. And I found, it's a pretty good strategy. The problem is that the nets and net cash stocks are only around in sort of quantities big enough to create a portfolio at the bottom of stock market crashes. And most of the time you need a different strategy. So I have this one that basically it still takes the same philosophy, like looking for a healthy balance sheet, but then it adds into that sort of equation, looking at the health of the business as well. And that's what I call the acquirer's multiple. So for folks who don't know it, that's basically using enterprise value on one hand. And that's, the cash on the balance sheet, any debt that it might have, anything that's like debt. So preference shares are treated like debt, minority interests because they affect your proportionate ownership of the business. And so then you're trying to come up with what an acquirer would be paying for the totality of the business. And then you compare that to what you're getting, which is the operating income. And so that's the acquirer's multiple. And that's the strategy basically that we use in the funds. So that's the first cut. We find things that are cheap on that basis. And then we do some other stuff as well. But that's the first step. So it's looking for absolute cheapness.
So on your website, it looks like you kind of cover your ETFs. So when you're using this acquirer's multiple framework to allow to give individuals who subscribe to your website opportunities to build their own portfolios, right?
Right. So we have a website that's got, just because I found it so hard to screen for these stocks, what I was doing originally, so Joel Greenblatt had this website where he had magic formula stocks. And I knew that because I had done some research that so basically what the magic formula is, it's looking for cheap on one hand using enterprise value to EBIT, which is a similar metric to the one that I use. And then it's looking for return on invested capital on the other hand and combining them together and trying to find companies that are cheap but good, sort of following a quantitative implementation of what Warren Buffett does with his wonderful companies at fair prices. When you test it, it does really well, beats the market. So I published a book in 2012 called Quantitative Value, where we tested that. Really does beat the market. But the interesting thing is what drives the outperformance. And it turns out that all of the outperformance and more is driven by the value part, and the return on invested capital part actually reduces your performance. And the reason is very simple. It's because return on invested capital is a highly mean reverting series. Mm-hmm. And so that's not to say that people shouldn't use it. There's about 4% of stocks resist this mean reversion in return on invested capital. And so when you're looking at those type of stocks, which is really what the Buffett stocks are, you got to look for, you spend 5% of your time identifying those stocks. You spend 95% of your time seeing whether the competitive advantages are real. It's working out what the competitive advantage is, seeing how sustainable that return on invested capital is. Can they continue to protect their margins and their returns over time? Because if they can't, then they tend to be, the profitability leaks away, and then you've overpaid for a stock that's ultimately probably just as cyclical, as closer to the top of its business cycle. So the testing that we did showed that the acquirer's multiple did a lot better by itself. And so I don't use return on invested capital in the site. We just rank them on the acquirer's multiple. And then we do other things in there as well. We make sure that they don't have any statistical indications of fraud or statistical indications of earnings manipulation or distress. Mm-hmm. And then we want to make sure that the cash flows roughly match the accounting statement, the accounting income. Mm-hmm. And then we just combine them all together, and we provide a list of them. So there's a free list, which is the top, drawn from the top 1,000. And then there's a paid screener that is for the small and micro, and for the for like the what I call all investable, which is basically the biggest 50% of the market. What I
found interesting, Tobias, is that you do take like a look at the quality of the earnings and the balance sheet. You look for fraud, potentially some signs of fraud, and you do also read the footnotes. So it's not totally there is a qualitative part to this, to what you're doing here. Or is there? I mean,
so that's true. So in this, the screeners don't incorporate that, but the funds definitely do. So I spent, before I was an investor, I spent a decade as a mergers and acquisitions corporate advisory lawyer in Australia and in San Francisco. And a lot of what you do as a corporate advisory guy is you find, there's a company that wants to do a transaction, they want to raise some money, or they want to buy another company, and you're executing the transaction. So there's a lot of the documents that execute the transaction. Then there's also reporting and producing prospectuses and things like that. And so part of the prospectus process is making sure that the financials give a fair representation of what's actually going on in the company. And so when I invest in these companies, I basically reverse that process. So I'm doing a forensic accounting analysis, trying to make sure that the financials of the company do in fact reflect the economic reality of the company. And in many cases, most cases, by far and away, the very vast majority of cases, they do. Every now and again, I come across something that has, particularly in small and microcap land, has like a very big convertible note from a hedge fund struck at, they needed the cash, struck at pretty favorable terms to the hedge fund. And it basically has the potential to wipe out any of the equity in there. So you need to know that those things are in there. So that's part of that process, just to make sure that hasn't worked its way into the fund.
Mm-hmm. Great. And so have you kind of like ran done some analysis where, okay, well, some stocks made it, were high scoring based on your rankings, and then there was a red flag that was missed that showed up later, on the risk side. Has that ever occurred? And
it's not occurred in the live operation of the funds. I've found that in back testing on occasion. So one thing in particular that it picked up a lot of the Chinese, remember the Chinese stocks. So this is before the stocks. I know you remember the Chinese fraud stocks, but they all screen very cheaply.
Right.
And you look at these financials and you think these are really some of the best businesses I've ever seen, and they're really, really cheap. What could possibly be going on here?
Right.
And the answer in many instances was just outright fraud. And the way that you caught that, this is one of the difficulties of fraud. It's really difficult to catch unless they're doing something that's sort of ruining the ratios in the company. And so they were being picked up on those sort of analyses. But there was some that were, I know of investment firms based in Los Angeles that invested into Sino-Forest or Sino-Forest, I'm not sure how to say it, including sending an analyst out to sort of view the forest.
Well, Paulson did.
Did Paulson do that?
Yeah, I think he was invested in. I believe he was invested in Sino-Forest. Yeah. So was that was? And
take a look at our forest. The analyst confirmed the forest did in fact exist. Just turned out that the company didn't own it.
Yeah, I remember during that time we were doing when Sino-Forest had occurred, there was another company not listed in the U.S., listed in Germany, called Bamboo something, and it was a similar Sino-Forest situation. And we we had all the due diligence, but we couldn't short it because of Germany's rules. So we ended up not because there would have been some legal ramifications on doing it on their which was ridiculous. Their kind of barometer for inside information was kind of murky. So like if the normal person in Germany couldn't find the due diligence, you couldn't write about it, or it was inside information. So basically traveling to China, I guess, to do the due diligence was considered out of, I guess, potentially,
Well, I think it's weird sometimes the way that they define insider trading laws, because the insider information, if you independently do some study, you can potentially generate inside information that, even though you're outside, you've made yourself an insider by figuring this stuff out, and therefore you're not allowed to trade on it.
Right.
Some of the implementations of insider trading laws around the world don't make a lot of sense.
No, they really don't. And and they're just it's not consistent too. So you're really in a tough situation there, right? What do you do? And
Germany had the same problem with Wirecard, right?
Yeah.
They chase the shorts there really hard. Let the guys doing the actual fraud, let them keep doing that. Let's get these shorts, man.
Right. Well, they've been pretty good here, at least in the U.S. for letting us do our thing. We were doing a lot of shorting for a while at Geo. But what we've seen, and this kind of comes back to some of the underperformance we've seen in some of the value stocks, is that there hasn't really been a kind of pursuit by regulators of fraudulent companies after that China period between 2010 and 14. And what happened, there was then you have the pump and dumps, a lot of that going on. And then even now going in that whole kind of movement moved into like mainstreams, the regular stocks outside China. So it really put, I think, regulators in a tough situation here. How they were out there halting these Chinese stocks for a long time. They were actually doing the right thing. But now what do you do when you have this whole financial system that might be based on, a lot of it based on these kind of companies that are walking the fine line? What does it mean for the financial system itself? And that's frustrating. And so you have these companies that are outperforming good companies that are low quality. It's pretty amazing. Then they had you start thinking like, well, wait, maybe the low quality ones are, what am I missing here? Maybe they're priced that way because they're like back in China, right? You have P's of 5s growing 100% a year and all these wonderful balance sheets of cash flow. And what were you missing? And obviously the market was telling you that there were PE5 or, these real for a reason, right? The market knew it was a fraud to some degree.
Well, I saw a value investing congress in Pasadena in 2010, something like that, and it had the guy from Hill House Capital. I'm sad that I can't remember his name right now, but it was the most spectacular presentation I've ever seen from a value guy, probably still to this day. He really does know his stuff. He's a phenomenal investor, and it was just during that period. It was before all of the shorts, I think, had been uncovered. Maybe there were some questions out there, but nobody sort of knew why the Chinese stocks were.
Right.
The reverse takeover stocks, whether they were all frauds or whether they were just a handful of bad eggs or something like that. And someone asked him, "Would you invest in these stocks because they all look really cheap?" And he said, "No, I wouldn't. I wouldn't touch any of them."
Yeah, and he was. I got lucky, but I got this lucky.
Were you long? You were short them, weren't you?
I was long in the very beginning, and then and
you flipped.
Ironically, the first stock that I went long in the space really made a lot of money on was the last one we kind of went short in the end. I wrote about it actually. So I was very long these stocks because I wanted to trust the SEC documents, these kind of things, and it just started not making sense. It was like, these stocks can't be that cheap, and have these wonderful balance sheets and growth.
And that's the tough thing with value, right? You're always asking that question when something gets really undervalued. Why God am I the one who gets this opportunity to invest this? What does everybody else know that I don't already know? So it takes some, it takes a little bit of faith sometimes to buy some of these things, knowing that probably the next reporting period is the one where you get to find out why everybody else knew it was a bad stock.
Right. And that's a whole GARP thing, right? Growth reasonable price. The GARPers, wouldn't buy things that are too cheap because they thought they were missing something, right? And that's kind of conundrum we get into. And there's something too, man, like revenue. I was going to ask about revenue growth because, you're focusing a lot on balance sheet analysis and the cash flow and which can, look very healthy even in periods of where maybe the company is not growing revenue for some time, right? There's that value there. And I think a lot of that maybe is, that's, if you can get both of those, you have a pretty powerful, I think, situation right now. And so revenue growth is that really not part of what you're looking for here, right? Or is it?
No, I'm not. I don't need revenue growth. It's nice when I can find it, but I much prefer bottom line growth to top line growth. And I know that there's a lot of people who feel the other way. They much prefer top line growth to bottom line growth.
Right.
I just like to see, I think that growth has historically been quite difficult to project and quite difficult to value properly. And typically what has been an easier thing to do is just to identify things that are too cheap. Stocks that are shrinking, businesses that are shrinking can still be very good investments. I know the last sort of 10 years aside, which is the last 10 years has sort of blown a little bit of a hole in this theory, but it's been a pretty good theory for a pretty long time that you sort of identify these things that are just babies thrown out with the bathwater. And even though the revenues are shrinking, the underlying business or the underlying intrinsic value on a per share basis can still be growing if they're managed properly. And so there are a lot of businesses that get to that cash cow stage that with a good management team in there, you can still get very good performance out of those stocks. The last 10 years have been a little bit miserable for that kind of strategy because it has been a market that has vastly preferred growth at any price and profitless growth. But when I think about value, what I'm looking for pretty simply is I want I want some sort of yield for the most part, because I like that the cash actually flows through. It doesn't have to be a dividend necessarily. I don't mind a buyback yield or something like that. And then I want, reasonable returns on invested capital, or over a full cycle where the business might be trading at a trough now because it's going through one of its poorer periods where it's struggling a little bit more, but given enough time, it's got the balance sheet to survive, and it should look a little bit better at the other side of the little business cycle that it's going through. And I think that those are the kind of stocks that they just get too cheap, and then they really don't have to do much to start performing again. So everybody leaves the industry because it's just too hard to make money in there. And all of a sudden there's this period of time where they do make these super normal profits before all the competition moves back in again. Right. So I don't mind buying cyclicals. It's not been a great strategy for the last sort of 5 years, but the long-term track record for it is quite good.
Yeah, I think that would just be, and that's in the long term, we might have to be thinking it's longer and longer term. And it's a tough mantra to keep preaching, right? But it's the truth. Yeah. At some point, we know that that will turn. And one thing I thought I'd see more of, man, is like acquisitions. These companies. Now there was a period where we saw some of that happening, and they just kind of stopped. I don't know if you noticed that in this smaller cap space, and I'm wondering why. I thought at least maybe private equity would get involved, and a lot of these firms, even when they were selling out, weren't selling at great multiples. And I'm wondering if you have an opinion on that at all. You ever thought about that? What's going on there?
Yeah, I don't know. I don't know what the rate of, other than just sort of, it's been an unusually uncertain period of time politically, and I just wonder whether that sort of had some impact. It does seem like private equity's raised a lot of money. Private equity has been out there, sort of, but not really doing anything with it. But I look at the companies that. Another possibility is that all of the firms have got quite good at fending off hostile takeovers, and so they've all got pretty lofty ideas about where they should be selling, right. And so they're just not open to any sort of transaction. But I look at some of the businesses in there now. So I don't know if this is small enough for you, but Diamond Hill, the Diamond Hill. Mm-hmm. So that's a value firm that's listed. The ticker's DHIL. I hold it in the fund. I hold it in deep. And it's like, phenomenal returns on invested capital, because that's the nature of the business. It's a very good business because it all sort of falls down to the bottom line. Mm-hmm. It's a very simple business. They run about $20 billion, got about a $480 million market cap. They're all cash. They don't have any debt. They pay out $1 dividend per quarter, and then every year they have a special dividend. So last year it was $12. This year it's $16. Jeez. So what you're getting, last year it was $9. This year it's $12. So it's a $16 yield on a $140 stock, which is, pretty good, about as good as it gets. And then the business should scale really easily. So once value sort of turns around a little bit, these guys are going to be beneficiaries of it. So that's the kind of thing that I'm looking for. The growth, it looks like it's going backwards on a revenue basis because it's a value fund and they've been underperforming and losing assets. But the underlying business is still very, very good. And they get a little tailwind at some stage, and that becomes a much more interesting, it could easily be $1 billion company. So it doesn't have, not much has to go right for them to sort of turn it around.
It's had a good performance off its bottom here, I see. It's had a nice little run here.
It's bounced pretty well.
Yeah. So this actually is one of my questions here. So I see this, I think they have about, what's their outstanding share? Like 3 million outstanding shares, is that right?
They've been, I'm off the top of my head, I don't know, but they've been pretty good at buying back stock too.
So you don't have, so when you and you have a market cap requirement, but you don't have an outstanding share count requirement, so you'll buy.
No, I know you mentioned that during our podcast, and I found that kind of interesting. But no, it's not. The absolute number of shares is not really that relevant to me. I understand why you do it. You're looking at companies that are still sort of at that financing stage, trying to break out of. Really, those microcaps are really sort of on the transition from being small businesses to being sort of listed microcaps. And I've come from, as a lawyer, I did some work with those smaller companies, with promoters trying to get stocks from, basically an asset or some sort of startup into that listed universe, which happens a little bit more in Australia than it does here. And that's often the way they do it. They issue a lot of stock. They're financed through stock. And so I understand why you do that. It's not so much of a requirement for me because that's typically not how these businesses are financed. These tend to be sort of bigger businesses, even though they're microcap. They're microcap because they've been squashed down on a valuation basis. It's funny. Like I look at quite a few of the names in the portfolio, and I recognize them because they used to be holdings of Zig that, just by virtue of the valuation, they've fallen under Zig's threshold and they've fallen into the deep universe. And so I just thought which happens, that's okay. But they're bigger businesses that have been bigger businesses rather than sort of startup stage promotions.
Now I'm looking at, but what I like, you will actually buy some stocks that do have low share counts. You're not averse to doing that. You're looking more at the market cap, right? In terms of Now I'm looking at your I think your deep ETF here, and it's pretty. You have a pretty good amount. I think you have about 33 stocks.
Yeah, there's 100. There's 100 names. Oh,
well,
sorry.
Under 500 million, I think. So
yeah,
you have
I see. Yeah.
You have and then you have there are 28. I think between that and maybe $1 billion. So it's pretty. Well, you do go pretty low in the market cap, which is nice.
Yeah, well, the cutoff is $75 million, and that's an NYSE listing requirement. But aside from that, I don't really care so much about the size of the company, provided that the underlying business is worth owning, and the company is worth owning.
Mm-hmm. So on your website, will you go? You don't have that requirement there. I guess you'll go as small as.
There's no minimum on the website. Yeah, so you'll find companies that are smaller than that in that screener.
Have you found that the smaller you go, the better the performance is, and the statistics?
It does seem to be that way. The problem is that the smaller you go, the wider the bid-ask spread becomes. So are you measuring performance, or are you measuring a wide bid-ask spread? I'm not entirely sure which. Right. So I'm always a little bit, and liquidity dries up naturally as you go smaller. So I'm always a little bit careful about making any claims like that. But it does make sense why that would in fact be the case, because there just aren't as many analysts following these little companies as there are following the big companies. Apple, everybody knows Apple. Everybody's followed Apple. Everybody's got an opinion. Everybody owns an Apple device probably somewhere in their house.
Right.
When you get down to these little ones, like how do you even pronounce the name of some of these things? I don't even know. Like it's not something that anybody would deal with. Like Diamond Hill, I can pronounce that name, but that's not anything that anybody would necessarily know. Like they wouldn't know that firm.
Sure.
And there are lots of business to business type businesses that just you would never come across otherwise.
Okay. Now I think you part of your membership, Tobias, you do give some one-on-one type of consultation. I think is that right? Did I read that right?
Yeah, so I have a consultation thing on there that people have used for to give a presentation to a group, or to help somebody design a strategy. But I just leave it up there as a sort of option for folks who want to talk to me in some sort of professional capacity, but it doesn't fit anywhere else.
Okay, so looking in the future, so you obviously are deeply entrenched in value investing and your approach. I'm wondering if you thought about maybe like eventually expanding to other type of strategies. For example, there's this one thing we like called looking at companies that are changing. So I guess theoretically, as the markets become more efficient over time, I don't necessarily buy that in what the space we play in this nano-cap space. And the whole, is there value maybe in kind of combining some of what you're doing with a little qualitative, something to predict change, right? So finding these companies that don't look pretty yet, but maybe the trend's moving that way, and maybe your opinion on that. I know it's tough because there's something that's there's a catalyzing event that you can't predict that maybe takes them there, right?
I don't mind that approach in a theoretical sense. It's just that to the extent that I have any skill in that area, I don't know that I do. I think that if I think about what coverage I have in the US at the moment, I have coverage of basically everything that is quantitatively cheap, and that's sort of from the large cap Zig to the small and micro deep.
And so the part of the market that I am missing when I was talking before about that, like that's the 96% of stocks that don't have the any sort of competitive advantage, but I'm missing the 4% of stocks that do have a competitive advantage. So those are the companies that everybody wants to own, but they never really get cheap enough. So it's just a different mindset. It's a different approach to those stocks. So to the extent that I would do something else, it's more likely that I'm going to be hunting for companies that are better businesses. So it's less of a question about valuation. It's that 5% valuation question, 95% spent on the qualitative side, but still trying to figure out where they have, do they have competitive advantages? Are these things really enduring? That's probably more likely the direction that I would go.
It's hard to find them, right? It's hard to find those companies that have that competitive advantage. And what I find a lot of in the space I play in, at least, is that these competitive advantage, and I think you kind of alluded to this earlier, they're maybe in smaller markets, right? Or markets that are falling that nobody wants to be part of for a while. And
it's funny.
You'll find that in the nano-cap world,
I find some of those companies do fall into the large cap screener every now and again. I think that the large cap screener on the site has the best collection of companies that I've seen in a really long time. For whatever reason, quality, the value bucket has been getting higher and higher quality. Nice. And I just think the reason is that the market has just prized growth so highly that the only thing people are chasing now is revenue growth. And to the extent that something doesn't have spectacular revenue growth, it's kind of thrown out and it's not considered. Whereas, revenue growth to me it's good to have, but it's not essential to have. What is essential to have to me is growing intrinsic value at some sort of speed. And the way you grow intrinsic value is either through good growth in the underlying business or through a management team that manages the capital structure and the shares outstanding in such a way that they're buying back undervalued stock.
Yeah, that was really, and you make a great point there too, about revenue growth. That was a really big challenge for me. When I first started investing, revenue growth was a big part of it. And then it became less as I moved on, and looking for these like maybe 5 or 10, 15% revenue growth, nothing crazy, but really expanding margins, expand their cash flow and earnings. That worked really well for 20 years. It was really good. And all of a sudden, 2008 comes along and everything changed after that. And it became about revenue growth. But it took me a while to figure that out. Like, why is this? I have to wait longer for a lot of my stocks to, appreciate to a value I thought they were fairly valued. And it took me, I've adapted to some degree, but I don't like it. Because I know you're playing with a loaded gun, I think. That's how I feel. At some point it's going to matter, right?
I think the sweet spot is like 13% because it's like everybody's screening. They want 15% and above. So I just want 13%, which is still really good growth. Yeah. And then if you've got a good management team in there and you can grow intrinsic value faster than revenue growth if they're doing the right thing, particularly on a per share basis. There's lots of levers that they can pull. Make the company more profitable. Use that profitability to buy back stock. All of a sudden, you get very, very rapid intrinsic value gains in your business. And it's not growth that the average retail investor is looking for because they're looking at revenue growth or they're looking for names that they recognize. So I think that there's a sweet spot of companies that fall in that sort of 13%, still low teens, but still pretty good rates of growth where the business value is growing even faster than that. It's just that it's optically not obvious on a ratio basis. You have to sort of dig into it a little bit more to see it. I can think of examples. Some of them are in the portfolios, but there's one in particular that I want to buy that I don't have in the portfolio that I can't mention. But next time we talk, I'll tell you because I'm going to buy it.
I can't wait. You have any stocks you want to share with us at all? Do you do that?
Well, Diamond Hill is one. Diamond Hill is one that's been in the business. I think this one's funny just because it's in the company. It's in deep as well. Big Larry Holdings. Mm-hmm. Are you familiar with Big Larry? So I hold Big Larry. I'll tell you why. I know this just makes everybody laugh when they kind of hear this company, but it's run by
Big Larry Holdings.
Yeah, Big Larry, BIGLARI. Okay. The ticker's BH.
Yeah. Okay. Let me get it here.
So, for people who know this company, they're probably laughing. For people who don't, I'll tell you why everybody else is laughing. So, basically it's run by this guy, Sardar Big Larry, who's kind of an unusual character, idiosyncratic personality. He's a very good investor. Let's just say that at the outset. For the last 20 years, he's outperformed the market. But he used to do this through a hedge fund. He's used this hedge fund to get control of Western Sizzlin and Steak and Shake and a few of these kind of businesses. So it's kind of a restaurant, and he's used it to buy some other assets as well, including Maxim. And he controls the A and the B shares. He owns I think he owns like 60% of the A and B shares. And he's used Big Larry to buy his hedge fund. So his hedge fund is then in turn invested in Big Larry Holdings. So it's this complicated kind of structure. For a variety of reasons, when the stock price performance is kind of reflected in the performance of the hedge fund, which is then, because it's wholly owned, it's run through the accounts of the business. So the financials, the income statement includes the performance of the underlying stock. It's a crazy setup. And so on top of that, he's been quite dismissive of shareholders. So
those are the best ones to buy, right?
So that's why it's cheap. You can buy it at I think it's got sort of $600 million in cash and securities, and you're paying like $200 or $300 for it at the moment. So it's very, very undervalued, and he's a pretty good investor. Just the issue is he aligned with shareholders? And I sort of argue that he is, because his compensation is as a holder of the. He's still paid on this sort of Buffett 0.625 basis. So he's and it's his name on the door. So he's incentivized to make this thing perform,
right?
Which I think he ultimately will. And I think it's very, very cheap. So I understand why people don't like it. I know that people there are all these hilarious stories about people going along to the general meeting and sort of explaining to him that they don't like the moves that he's made, and him just saying, well, sell your stock. Like he's completely unrepentant. So it's one of those things that there's nobody in the world who really wants to own this thing, but I kind of think it's too cheap, and I think he's going to do well enough out of it that if he performs, that it's worth him making the effort. I think it's going to go okay.
I look at that. I mean, some of those actually people like that who are. I mean, he's probably cocky to some degree, but he's like, you either trust me or don't trust me. Take it or leave it kind of guy, right? And and I've had pretty good success with those guys. I'm going to check this one out for sure. That's awesome. I never heard of it. I'm sorry. I just they have 2 million outstanding shares too. So you're hitting that in the market, 2 of them in a row.
He's a big Buffett guy, which is why it's the ticker's BH, like Berkshire Hathaway, Big Larry Holdings.
Excellent. I see it here. Yeah, here it is. Yep. It's back to this. This whole there's a company that I own called Agent Information, I think, software, and it's a small little company here. Let me see if that's the right. And it's just boring agent information software. It's a boring library management software company. Been around forever. I mean, like maybe 30 years or longer. And actually, I'll tell you exactly. Let me see if I can get this here.
Is it controlled?
It's about 51%. I mean, insider ownership is about, I think, 50%, 51%. And the CFO, the CEO right now, it was handed to him by his father, and his father had to give it to him, so definitely very, closely controlled with family. And, this is an interesting thing because, this is a typical situation I like is the company was founded in 1969, actually. When IPO in 69 was founded in 1950. And they've gone through this, they were a typesetting company, and then eventually that morphed into this whole library management software company. And they have $5 billion in revenue, and it's but this is where their growth, they may be growing 5% a year revenue, 10% if we're lucky. And they have all this wonderful software assets. They've been really targeting the library market. And there's a piece of segment of the market of what they have 2 markets. They have one is it's like back office software management, which is very competitive. And there's about 9,000 libraries that they go after, mainly public libraries, but it's a much bigger market. I think closer to 100,000 if you look at all libraries. And but there's another piece of the market, which is this kind of like called Share It, which is basically helping libraries more efficiently manage their library sharing kind of lending system, right? And it's pretty cool. And so basically, but it's a small, it's worth about $10-20 million market. So right. When I'm talking to employees, like, everyone's leaving the market, just leaving it to us for something. No one wants it. It's like, love to hear. And they're a $5 million company, right? I'm based in about $4 million of that, I think, is with that thing. And they're in 15 states. And this is a typical situation where they've been around for so many years, just hanging around, waiting for this catalyst to happen where, it takes it to a situation where now revenues maybe one day grow at 20%. And that's what's cool about these ones that are growing like 5-10%. Eventually they stick around so long that they hit this like little flywheel thing where you've gotten that first kind of return where they're growing 10%, and all of a sudden, boom, right? Then they get the growth guy investors come in. Well, you've been in for, and you're going to sell to them. You get that last leg of the multi-bagger, which is pretty awesome.
Yeah. It's never happened to me, but I imagine it feels pretty good when it happens.
Well, you got to, when you're wrong, it doesn't.
I mean, that's the problem for.
It happens a lot too.
That's the problem for value guys, right? Always selling too early. I think that's the toughest thing for a value guy is just when you get that little bit of a run, just to hold on for just to let it go for a while. I've never been very good at doing it, but I think that it is probably the missing ingredient for a lot of value investors.
Yeah, I guess in order to you got to be outside the comfort zone, right? And you got to go outside. And it's not easy doing it because you might be holding a stock that's not, that's overvalued to some degree.
Right.
And it's really difficult, and it really challenges the sell discipline. And which is why you try and find stocks that get acquired one day. That solves all problems.
It does. That's it.
But that hasn't been. It's been a lot less these days. But so I just thought that there's another few other companies like that I own too that I've owned that have these really small kind of really niches, and they own all of it. And it seems there's value there, right? And some of them get acquired. Yeah, man. So this is the one thing I had let me go through my questions real quick. So I had a bunch of questions I still want to ask you. But I think you might have went through a lot of them here. So I guess that is a good question to ask you. So you kind of brought it up, and in terms of what on your website you do talk about the holding period. Like you put the formula together. Step 1, 2, 3. At the end of the year, kind of reevaluate what's going on. So what is a typical holding period for you?
Yeah, I think I don't really, when I put something into the fund, I don't really think about it for about a year because I think it takes, what are the chances that you buy something at its low, very low? It's more likely that you buy it and it's still in the process of turning itself around. And that can take a few quarters typically before that starts sort of manifesting. And so I just reevaluate it at the end of the year. And if it continues to be deeply undervalued, hold at that point. And if it's sort of risen, then sell it. I think that it's hard to sort of argue for that kind of discipline in a market that's been like this, where you've only been punished for doing anything that I've sold has continued to rocket higher.
Right.
And, anything I bought has continued to go lower. But that's sort of the difference between the discussion you have at this point in the market and the discussion I was having, at the lows a decade or so ago, when through 2007, 8, 9, there was nobody who was kicking themselves for selling too early. Everybody was, wishing they'd sold when they had the price. Like, I had the price, I didn't sell because I thought it was going to keep on going higher. So I try to be pretty disciplined. I sell. Typically what we're doing is we're selling to rebalance into a cheaper opportunity. So it's a pretty easy decision for the most part, where the nature of the ETFs is that they are deep value ETFs and they have to be run continuously for new shareholders, new investors coming in. And so we're always trying to be concentrated at that very cheap end of it. And when anything leaves that very undervalued part, then we're rebalancing out into something that's otherwise undervalued. If I was running a more discretionary type partnership, I wouldn't be doing it that way. I'd be looking for stuff that I could hold forever, essentially. Mm-hmm. But those kind of businesses, like I said, that's about 4% of businesses, and that might be overestimating. There might be 200 or 300 of those globally.
Right.
And maybe there are like 50 or 100 in the States, or maybe 150 in the States, something like that. So they're very, very few and far between. Everybody knows what they are, so they never really get particularly undervalued. The only way you kind of get into them is through some sort of, you just have to wait for the market dislocations. But I think you get one about once a year. There's a pretty good market dislocation about once every year. Typically, the difference between the high and the low for a stock over the course of the year is about 3x or 30% of its high. So if you have your laundry list of things that your shopping list of things that you want to go and buy, whenever they go on sale, you go and pick a few of them up. I think that's a pretty good approach. So if I was running more discretionarily, that's what I'd be doing, rather than the sort of continuous thing where we have to be continually pushing down into the cheapest stuff.
Right. Awesome. So I guess we have to talk about, we have the elections over. Do you have any opinion in terms of what this means for stock, what it means for the value investing type of style approach here, or do you even care at all? Or
yeah, I sort of think that who the president is really doesn't make much difference to the performance. It's not something I really ever worry about much, and it's one of those things that's just outside of my control. So there's no point, I think, worrying about it one way or the other. So there's certainly different policies impact probably at a tax level that might make a difference. I had no idea which way the election was going to go, and I had no idea which way the stock market was going to go. Like on Friday afternoon or whenever it sort of came out, it looked like Biden was leading. And then, like, if someone had said to me on Monday the stock market will be up 10% or down 10%, I'd have said, well, that's of course. So then it was up a lot. So I was like, well, there we go. That's, I have no idea. I just have no expectation about what's going to happen at any point in time. I just think you're better off focusing on the stuff you can control and just not worrying about anything else.
It's so true, man. And so many people are just, we waste so much time talking about this, what's going to the if then, and they end up making no decisions anyway. It's just all about talk and
right.
I called it, whatever. But yeah, I mean, I'm with you on that. I mean, there's going to be winners and losers. It's our job to find them, depending on the environment, right? And what I've learned too is great companies just figure out how to adapt anyway.
That's it. That's it. If the company can't figure out how to adapt to one environment or another, you probably weren't going to own it anyway. So it doesn't really factor in too much, unless there's some sort of specific policy that that the new guy is going to take off that was helping or hurting one of the companies. And if you can see that coming and that it's going to be a catalyst, but then those things always take longer to work out than you think they are anyway.
You do. I remember I've never been a market timer, and never, especially around the elections. And I got, because of social media and, everything's so in the open, I got sucked into it on the last presidential election. And I had all these MicroCap stocks. They were just getting crushed. I don't know if you remember that before Trump got elected on his first.
I remember value was getting beaten up on the way in.
Yeah, it was getting. This was incredible, and I got spooked out, and I sold a bunch of stuff. And that was the first time I've ever done that, and I paid dearly for it because, it was all the infrastructure stocks. I had everything that basically would have been good for the Trump victory. I didn't care. They in the end they both would have done well. But I learned my lesson just to, if I'm going to take a hit, I'm going to take a hit. I don't care which way it's going to go.
That's it. I thought the craziest thing about the last election was that everything started rallying on the Thursday before the election. Everybody sort of seems to remember it as being like maybe the market knew that Trump was going to win. I don't know, or maybe, I have no idea, but there'd been a lot of uncertainty coming into that. And then I saw it in the value stocks. Everything was sort of getting crushed, and then everything just took off. It was great for my strategy that early period after that election, but then it hasn't done much since that period of time. It's all bumped sideways. So, today I know that I don't know exactly when the podcast is coming out, but this is the Monday. This is Monday, November 9th. And so it looked over the weekend like Biden's got there, and for whatever reason, today was a very good day for cyclical value type stocks where everything sort of rocketed up today.
Right.
And I had no idea that was going to happen on Friday afternoon. If literally, if someone had said it'll be the other way around, I'd be like, oh, well, I have no idea. I have literally no idea.
I had a bunch of stocks that were kind of playing the I mean, I don't buy COVID themes or anything, but I happen to have some that had a little bit of that theme to them. I bought them not because of COVID, but because, maybe COVID enhanced them, in my opinion, their long-term growth trend.
Right.
And what happened was, so I had these stocks, and but when you had the vaccine announcement, we had no idea that was going to happen today, right?
Right.
And anything.
Or that it was going to have such a big impact.
Yeah, I mean, I thought it was. Yeah, I was talking to my buddy about this, Ed, and we were talking about it like a month ago. Like, this is going to be a non-event. It's not going to even mean anything. I think because it was such a 90% success rate, they were saying with the vaccine, that was what was interesting about it. And no one really, everyone in Fushi 50%, was the success rate everyone was talking about. And this was, of course, they were wrong. And what happened today was all these momentum investors that were in these stocks and have no idea what they're investing in. Like, we got to get out of the COVID trade, no matter what. Without reading anything about the companies, and the press release. And there's some of these companies were going down. We're like, hey, even before this happened, before any of this, we're gonna do fine. Actually, when the economy reopens, our trajectory is even better because of the things we're addressing post-COVID that are going to be important. And people didn't care. And I couldn't believe the swings we were seeing today. It was amazing.
One of the funny ones today that I was just sort of following peripherally, but Beyond Meat, BYND. So McDonald's came out and said that they've developed a McPlant burger, and McDonald's spiked on the news and Beyond fell on the news. So then Beyond released a press release saying, we worked with McDonald's to make the McPlant burger, at which point they sort of rallied really strongly. And then after the close, they've released their earnings and they've had this massive miss. And so, so the stock's off like 35% after hours. I don't know what to make of any of it. It's that all that stuff's sort of too hard. I just, that's one of the nice things I think about being a value guy, is that you focus on, you got something to focus on besides the stock price. I want to see what the next quarter reporting holds. Has the intrinsic value held up or grown over the course of the quarter?
Right.
Where's the stock price relative to that? So I just think that's a lot more calming. It's a lot more soothing than sort of following the gyrations of the stock market every minute or hour or day.
Well, what's nice too is it just gives you a framework of discipline, I think.
Right.
Which is really important. And consistency wins this game. It can win this game too, right? Make sure we can hit those multi-baggers, but being consistently right and being able to make decisions and sleep at night and know what there's something to be said to that too. And I think that's an advantage to what you're talking about also.
You just have to make all of the mistakes. And then once you've made all of the mistakes, you never finish making mistakes. But I feel like I've made like a decade's worth of mistakes over the last decade. So I've learned some things.
Speaking of how was your behavioral kind of emotional mindset into investing? I mean, have you ever had a hard time with emotions and taking over?
I think that when I first started out full time, that was when I really felt it more than I ever had before. Before I was doing it full time, I was pretty good at it because I'm only doing it on the weekend or after hours. And then when I started doing it full time, got so much more time to kind of really mess yourself up. That's when it first kind of kicked in, and that's when I became more quantitative, because there's a lot of that is anti-behavioral bias. But the longer that I've done it, I think that part of it is just, you got to get over this desire to be right or wrong. So I've stepped out of that, and I think about it more at a portfolio level, and I also think in longer time frames, and I think all of those things sort of help.
Did you ever in your life try and trade at all? Did you ever go through that phase of day trading or swing trading at all?
I've never gone through a phase of it. I've done like once or twice, like literally only once or twice. I knew that there was an announcement coming in something, and I just traded it for the announcement. And because I was so over the stock, I knew that something was, so I just massively overweighted it for what I would normally hold, knowing that I was going to sell it the moment that the release came out. So I've done that on a handful of occasions, but because I had very specific knowledge about something that was happening.
That's why you're so happy.
It worked. Yeah, that's right.
You don't have to go through that trading stress.
I'm a terrible trader. That's what I've learned. I'm just a garbage trader trying to get in and out of positions. So I have zero skill there, negative skill there.
I don't enjoy it at all. It was
it's stressful as hell.
stressful time. And it's you can be right 80% of the time. It's not 20% you're wrong.
We only think about the errors. You only ever think about the mistakes that you make.
Yeah, it's naturally hard to like, oh, how stop losses. Well, until it gets there, right?
Yeah, that's it. It just bounces off your stop loss like a ping pong ball.
Yeah,
like a golf ball off a concrete path. The moment that you put the trade in or not, it goes the other way.
Yeah, it does. I guess people can do it, and I mean, I've never been the best at it either. I like having a fundamental reason for doing things, but I mean, I'm sure there's a talent there, right? I mean,
I think that I'm sure that you can get good at a particular. I'm sure that people understand how something trades. I'm sure you can do it. I'm not one of them.
And one last thing, momentum. I think that was something we talked about in our podcast before. And is that something maybe use your personal investing, or do you believe in it? I think, right, to some degree.
I use it on the short side to make sure that the stuff that I'm shorting doesn't have a great deal of momentum in it. Because I just think that shorting's there's a little bit of a dark art. It's not necessarily a reversal of value investing. It's sort of looking at, you really want, junky balance sheets, distress, statistical earnings manipulation, statistical fraud. You want those things present in a short. But if I use that screen and then I look at the market, that portfolio probably goes up 35% a year because it's all the pretty junky stuff that's speculative and people like.
Right.
So on top of that, I just make sure that it's trending down. That's sort of, for whatever reason, the market's either just figuring it out or doesn't want to support the story anymore. Because often the stuff that I buy has immediate needs for cash flow, and it either needs to raise some debt or it needs to sell some stock. And if they're kind of trending down, I just know how hard it is to do it. When I was a M&A attorney trying to get those deals across the line, when the stock price is going against you, that the mark keeps on getting set lower and lower, and the size of the raise gets bigger and bigger. It's been a really friendly market to those kind of businesses, so the shorting hasn't been a great experience so far. But I think that when the market falls over, you really get to see the value of the shorts.
Oh yeah, the shorts they haven't been working at all. I mean, short sellers are being crushed, especially like in 2019 20 was a pretty tough year for a lot of good stories that seem like frauds. But it's just
right.
Have you been lucky enough to be short when like a muddy wash report come out or a fraudulent report has come out?
No, never. I've been lucky enough not to be short Tesla over the last year because I have been short Tesla on occasion. I think I've made money and lost money. Nothing particularly great there. But I would never be in something like Nikola. Like I'm never in something that ramps and then falls off because I wouldn't ever short the ramp.
I see.
So I'm never trying to pick the top because I think it's just way too hard. So I tend to be in stuff that it was something that was very popular. It's just fallen off the radar, and then people have kind of forgotten about it because they've moved on to other more interesting things. And I'm just catching the tail end of the short. So
your short strategy is based upon, is it more on liquidity or more on fraud, or a combination of both things? Like,
it's still sort of the reverse of the long portfolio. I'm looking to the extent that I can determine a valuation, which is not easy. They're extremely overvalued. They're losing cash. They've got heavily indebted balance sheets. And there are some of those statistical indications of something wrong with their accounts, like the cash flows just don't match up with the accounting statements. So then on top of that, the stock price is trending down. So it's sometimes it's hard to identify those sort of stocks, but there's no
so you're basically like relative value to everything. You're just looking at valuation more on the short side too, just like you are on the long side. And the fraud element adds to the story a little bit if it's there.
Yeah, it's that to the extent that I can value these things, often I can't because they're all narrative. The story is in the narrative. The reason that they're so pumped up is because the story is very compelling, and it's the financial statements just don't reflect the story at all.
Mm-hmm. Great. Any opinion on regulators and what they should be doing? Are you happy with the way things are going? Or you like the way free markets are kind of handling it? It's a tough line, right?
I don't really have any specific thoughts of my own on those things. I see people complaining. I see people complaining about the SEC not enforcing, slapping Musk on the wrist for his little things and then not following up with those kind of things. I don't really have a view. I just don't know. I'm not close enough to it to know what they're looking at, what they're not looking at.
Right. They're in a tough situation because are they going to take to actually find? They can taking a short seller's report at face value as opposed to doing it yourself, and there's a lot of there's so much mayhem out there, and so much fraud, pump and dumps that theoretically the SEC would have to go through all that, instead of trusting these reports necessarily, right?
I think the short, let the shorts do let the shorts do what they do, which is to release those reports, and they come out pretty regularly. There's a lot of shorts out there who do pretty good work, and so that's
let the market take
that's
care
what you do.
Right? The market. The cool thing about China was, these stocks had to fail. They were so fraudulent that they're going to fail, right? And it was so easy to prove the fraud.
I've been on the wrong side of short reports on a few times. I held St. Joe's when David Einhorn came out with his second short report on St. Joe's, and I was present in the Value Investing Congress in New York and watched him walk through this 128-page slide deck that was excruciating because they'd driven the streets. And that was at the time that Bruce Berkowitz was long. Bruce Berkowitz was fund manager of the decade, lives in Florida, right close to this thing, should know it pretty well. And Einhorn had gone through this 128-page deck in detail, driving the streets, pictures of the houses not being built. And they kind of asked Bruce Berkowitz who was long. They're like, what do you think? He's sort of like, it'll work out. And I went, oh my God, sell Mortimer.
Oh man.
That wasn't great. And then Einhorn shorted me again. Einhorn dropped a bomb on me again with AGO, a short guarantee, which I still think AGO is a really great stock. Dom Federico, the guy who runs it's super smart, good business. It's just that it's got a whole lot of headline risk. And it sold off sharply when Einhorn shorted it. So Einhorn's got me twice.
Oh, no. Well, payback. You need payback.
Hit my battleship twice.
Yeah. Well, thanks. This is awesome, Toby. I'm really glad you did this today.
My absolute pleasure. Great chatting to you, Maj.
I know you're always. So, what do you? What's on the next in the docket? Are you doing any more podcasts or any kind of engagements in the future here, in the near future?
Yeah, I have. I always while Deep is fresh, I'm out sort of talking about Deep and trying to let folks know that there is the small and microcap value ETF that's the last thing in the world that anybody wants at this point in time. But I do think that it's a good idea given how bad the sentiment is and how beaten up they have been. And I think that today was a big turnaround for value. And at some stage, value is going to go back to its sort of long run trend of doing pretty well. So I think that today could be the beginning of something.
Well, I'm glad you're doing it. I mean, it's good for the space that you do on this too. I love that, and I'm hoping some of my stocks will find your way into your into your index. I looked at it and saw some interesting names I recognized. So that was good.
You got some big enough. You got some big enough stuff to get in there.
There's a few, but today they were smaller than they were on Friday.
Yeah, that's happened to a lot of my stocks too.
Yeah. Awesome. Well, thanks, Toby. It was awesome. And any kind of thing you want to talk about in your sign off, where they can find you. And
yeah, if folks want to look at the screener, that's on acquirersmultiple.com, and it's got links to all the books that are written. If you want to know more about the funds, acquirersfunds.com. So the two tickers are ZEG for the long short value fund and DEEP for the small and micro value fund. And I think that's it.
Excellent. Thanks, Toby. Are you there, Robert?
Yeah, Robert is here. Yep. You guys played very well together. That was a really nice play date that I just saw.
Good.
And, I really appreciate that. So real quick, I'll land the plane. You can find out more information about Avoiding the Crowd with Maj Soueidan at avoidingthecrowd.podbean.com. You can listen to this podcast wherever podcasts are available. And you can also watch this interview on the SNN.Network YouTube channel, which is youtube.com/SNNWired. I think that's all I got. I was going to ask a question, but I think we covered everything. So, yeah. With that, all right, guys. Take care. Have a good one, and we'll talk soon.
Thanks, Bobby. Thanks, Maj.
Thanks, man.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN.Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy, sell, short, cover securities in any company mentioned and may profit in the event those securities rise in value if we are long and fall if we are short. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.